everybody. I'm Jessica with BCID.
And I'm Jose Hernandez with United Spinal Association, and thank you for joining us. We're going to go over a few housekeeping rules.
Yes. Today we have the lovely Miss Brown here. And you are on panelist view, so you won't be able to see yourself or speak. I think so. If you have any questions, please put them in the Q&A. Try to keep your questions for Miss Brown in the Q&A so we can get to them as good as possible, and in the chat amongst yourselves as much as you want. And we have the lovely Mary here. If you only want to see her, you can go ahead and right click and pin her.
If you need closed captioning services, you can click on the closed caption button at the bottom of the bar, or you can use the link that I am going to put into the chat. Also, to make it a little more interactive, Ms. Brown loves to see people put up their hands, and you raise your hands up, and we will yell you out. So, yep.
Yes.
Um, we're here again, for part two about managing your money. And go ahead, Ms. Brown. It's all on you.
Thank you, Jay and Jessica and Mary. Good afternoon, everyone, and thank you for joining us once again. If you were here last week, welcome back. I am honored. And if you missed last week, I just want to do a little housekeeping myself really quick. My name is Debra Brown, and I am, among a bunch of other things, a financial coach for a really great company called Community Service Society, and I am currently working out of BCID. I also have my own business where I wear a variety of hats: tax law, tax prep, financial advisor, yada, 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 et cetera, et cetera, et cetera. At some point, we're going to be doing some basic information. And at some point, you may want to dig a little deeper, or you may want to personalize stuff. You can always reach me through BCID, Kim at BCID. You can call her and make an appointment and set up a one-on-one with me over the phone or over Zoom. That phone number is BCID is 718-998-3000. That's 718-998-3000. Speak to Kim, and she will be more than glad to set up a one-on-one between you and I. So, with that said, let's get started. Last week, I talked about income tax. We talked about different types of tax, but we honed in on income tax. There were a few questions at the end of last week's webinar, and I want to start this week by answering those questions, and hopefully it will be a perfect segue into this week's credit reports and budgeting, and hopefully I'll get into a little bit of savings before our hour is over. So one of the first questions that I wanted to address from last week was, how does earned income tax credit affect people with disabilities, without children, or dependents? So we're going to take a little look into earned income credit. If you remember last week when I was talking about taxes, income tax, I said there were two different types of credit: refundable and non-refundable. Earned income credit is a refundable credit. So we're going to look at how you qualify and how you apply for these credits. It's gonna be fun. It's not gonna be any heavy thinking. So we're gonna go over to another screen right now. And I'm going to pull up this is actually publication 596. It is the Earned Income Credit publication. All publications are free from the Internal Revenue Service. You can get them online, or you can call up and have them send the actual hard copy if you like. I'm going to start on page 2 of this Earned Income Credit pub. And if you notice, this table 1 is Earned Income Credit in a nutshell. Well, I don't know. I wouldn't say a nutshell. I would think the shell was a little bit bigger, but I'm going to try to break that shell down for you. Okay, we have chapter 1, rules for everyone. And I'm going to start, even though they have them numbered, I'm going to start with the rule that I think is the most important, which is rule number 3. If you see here in column 2, rule number 3 is your filing status cannot be married filing separate. I think that's a very important. I think I would have put that first, because if you're doing married separate, you will not get earned income credit, which means you have to be filing as what? Either single, head of household, or married joint. One of those 3. Okay, so if you're doing married filing separate, that knocks you out automatically. Okay, number 2, you have to have a social security number. Number 4, you must be a U.S. citizen or resident alien all year. Number 5, you can't have foreign earned income. Number 6, your investment income must be less than $3,600. And number 7, you must have earned income if you want to get earned income credit. Now, after you meet those criteria, let's go over to the left to the first column, your AGI. And remember last week we talked about AGI. You have gross income, and then you subtract whatever adjustments you are entitled to, and that gives you your adjusted gross income, which is your AGI. So if you have 3 children, your income must be under $50,162 for a single or head of household. Married joint, of course, is in the brackets. If you have 2 children, your income must be below $46,703. Single and head of household. Married joint would be in the brackets. If you have 1 child, your income must be below $41,094 for single or head of household. Married joint, of course, is in the brackets. And if you don't have any children at all, but made under $15,570, you are entitled to earned income credit. Okay, and then married joint is in the brackets. So there is a way to get earned income credit if you have no children. But in addition to these rules in these first 2 columns, we're going to jump over 2 columns. We're going to jump over 3 columns to chapter 3, where it says rules if you do not have a qualifying child. This first rule, number 11, is very important. You must be between 25 and 65. So if you are 24 and made less than $15,570, you still will not get that earned income credit if you don't have any children, because you must be between 25 and 65. You cannot be the dependent of another person. You can't be the qualifying child of another person. And you must have lived in the United States for more than half the year. Okay, if you have children, we're going to go one column over to chapter 2. If you have children, your child must meet the relationship, age, residency, and joint return tests. Your qualifying child can't be used by more than one person to claim the earned income credit. You can't be the qualifying child of another person. So, for example, I'm going to look at number 9. Your qualifying child can't be used by more than one person to claim the earned income credit. Of course, if you and your ex-spouse share a child, you both may say, the child lived with me half the year, the child lived with her half the year. How is it that they're going to see who gets to take the earned income credit? Well, another test comes into play, and that will be how much each person made. They have a way to differentiate who is going to actually be able to take the child as the earned income credit and enable them to get the earned income credit. Now I'm going to back up to number 8 for a second. Your child must meet the residency, age, relationship, and joint tests. I know what you're thinking. You're thinking, well, Ms. Brown, how do I know what the relationship, age, and residency tests are? And in this same publication, if you come down 1, 2, 3, 4, 5, 6, here you go. Here is figure A, test for qualifying child. The relationship test. Your qualifying child is a child who is your son, daughter, stepchild, foster child, or a descendant of any of them. For example, your grandchild. Or it can be your brother, sister, half brother, half sister, step brother, stepsister, or a descendant of any of them. For example, your niece or your nephew. The age test. The child must be under age 19 at the end of 2018. Under age 19. So if you turned 19 within that year, you no longer qualify. You had to have turned 18 because you have to be under 19 years old. Or if your child is a student, you can get earned income credit up until they are 24, under 24. So actually it would be 23. They'd have to have their 23rd birthday that year. And then you would be able to still, as long as you fell within the money guidelines, be able to get earned income credit. Or if your child is permanently and totally disabled, there is no age limit. As long as you're under the guidelines, you will be able to get earned income credit for that child as long as they live with you. The joint return test, the child cannot be filing a joint return. And I know you're probably saying, what scenario would that possibly happen in? Well, suppose your 22-year-old married someone in the military and their spouse was stationed overseas. And while they were over there, they were staying with you. They were staying with you more than 6 months out the year. they're going to college, they're under the age limit, they're 22, you know, as long as they're not filing a joint return with their spouse, then you will be eligible for earned income credit. And finally, the residency test. Of course, they had to live with you for more than half of the year. So I hope I cleared that up about the earned income credit. But while we're talking about credits, there is one that I didn't get a chance last week to talk to you about. And I want to talk about that really quick. It was actually on the state. This is the last page of the New York State tax return. And I want you to look at numbers 67. Line number 67, real property tax credit. 69, New York school tax credit. 69A, which is the New York school tax rate reduction amount, and 70A, which is the enhanced real property credit. You may be entitled to these credits even though you do not have to file a tax return.
Ms. Brown, do you have it on screen?
Yes, I do. I think I do. Yeah, I have it up on the shared screen. You see it?
No, actually,
It
we
says
don't.
page 404.
No, we don't see
You
that
don't
one.
see it?
It's probably a separate form. You have to reshare and select that. Either select your screen so that everyone can see your entire screen.
Let me see if I can do this. Can you see it?
No, not yet.
You still can't see it?
No.
Okay. Well, let me see if you can see this one. One of the credits that I was talking about, the earned income credit, not the earned income, I'm sorry, the school tax credit. Can you see that?
No, when you hit the screen share,
You have to reshare again.
yeah, she already stopped sharing, but
Okay.
you select the window that says the share screen.
How about this one? Can you see that?
Yes.
Okay. This is the New York school tax credit. If you are not filing a tax return, you are entitled to this credit. I believe it's $63 for the year. They will also give you partial credit if you were here only 6 months or 3 months. They'll give you 1/3 the credit. And if you see where it says note, it says use this form only if you are not required to file a 2020 IT 201 or IT 2013, which is the regular return, and you lived in New York City for any part of 2020. That means when they say New York City, that means you lived in Kings County, the Bronx, New York County, which is Manhattan, Richmond County, which is Staten Island, or Queens. That is the criteria for this credit. You must have lived in one of the 5 boroughs for any amount of time, 1 month, 2 months, 3 months. You fill in here how many months you lived in that borough, and they will send you that credit. You can also have it directly deposited into a checking or savings account by putting your routing number and account number in these boxes. So I just wanted you to be aware that there was, even if you have no filing requirement, there are credits that you are entitled to. I want to move on now to the question about medical expenses. And I am definitely going to try to get this right. Do you see that? Do you see that page?
Yes, we do.
Okay. Oh, wait a minute. That's not it. The medical expenses, wait a minute. Hold on 1 second. I'm going to pull up a different page. I'm going to stop sharing. I'm going to pull up this other page, and I'm hoping that you can see it. And someone had a question about medical expenses. Medical expenses, if you remember, I told you is on a Schedule A. Think I got it. Okay, it's on the Schedule A, the itemized. If you remember from last week, you had the choice of either itemizing or using the standard deduction. Okay, this is the itemized, and it would have to be more than 7.5% of your AGI. Anything over that, you would be able to deduct. So let's talk about what kind of things you can deduct. Okay. All right. And this is the instructions for the Schedule A. And on the instructions for the Schedule A, they tell you exactly in this last column here, medical and dental expenses. They tell you exactly what kinds of things, examples of medical and dental payments you can deduct. Insurance premiums for medical and dental care, including premiums for next page. For qualified long-term care insurance, of course, you have to refer to another pub for that. You can also do prescriptions, medicine, insulin, acupuncturists, chiropractors, dentists, eye doctors, medical doctors, occupational therapists, osteopathic doctors, physical therapists, podiatrists, psychiatrists, psychoanalysts, as long as it's medical care, psychologists. You have a whole list here that you can go through. Medical exams, diagnostic tests, it comes all the way down, long-term care. You can get this, as I said before, this is free. You get it from the IRS site, www.irs.gov, and you can go into this, weight loss programs, medical treatment for drug or alcohol addiction. These are all things that you can, medical aids for eyeglasses, lodging expenses, but not meals while away from home to receive medical care. You want to go through these two columns carefully. That will tell you all of the things that you can deduct. It will also give you examples of medical and dental payments you cannot deduct. The cost of diet food, cosmetic surgery, unless it's necessary to improve a deformity, life insurance or income protection policies. This is a very good publication to go through to figure out what you can and cannot take off in that section. Okay, now I saved the best, I think, for last, which is someone asked about the taxable portion of able accounts and pool trust accounts. Okay. And we're going to get into that right now. Share. Tell me whether or not you can see this. Can you see this?
Yes, ma'am.
Okay, great. I'm getting better. Yay for me. Okay, I'm going to start with pool trust. Okay, trust created for individuals with special needs generally fall into two broad categories. Those created with the beneficiary's own funds, which is known as a first-party trust, often from proceeds of a personal injury settlement or those funds from a third party, often grandparents or parents or grandparents, and those are a third-party trust. And the tax treatment on the two is a little different. The first-party trust, because the funds come from the beneficiary and he's the only beneficiary during his lifetime, for tax purposes, they are grantor trusts. And as a result, for tax purposes, the trust income flows through to the beneficiary, whether or not it's actually distributed to him or spent on his behalf. So for a first-party trust, you would actually be paying the taxes yourself. For a third-party trust, which is what the pool trust is, it's a third-party trust. I'm going to use this example. Let's assume a third-party special needs trust earns $20,000 in a year and uses $10,000 in distributions on behalf of the beneficiary. It will file a 1041 return reporting the $20,000 in income and deduct $10,000 of the distributions and roll that over on a K1 to the beneficiary to report on their return, while the trust will pay the taxes on the remaining $10,000. This will result in about $2,000 of taxes. This next paragraph I thought was very interesting. This may seem high, $2,000 for just $10,000 of taxable income. After all, the standard deduction for individuals is $12,400. And last week, I told you if you were under the standard deduction, you didn't have to pay tax. Okay? Well, trusts have no standard deduction and they have an accelerated tax schedule. So they will reach a 35% tax bracket at $9,450 of income. As a result, it can be very expensive for third-party trusts to accumulate too much income. And you have to balance that with the distributing of of whatever the beneficiary needs. So yes, on a pool trust, you will have to pay tax. There was something else I wanted to tell you about pool trusts. Let me see if it's in here. I was going to explain to you about the pooled, was it? Well, if you go to the internet, you can find a lot of, I had to do a lot of research actually to find these answers for you guys, because I really wasn't too good with pool trusts and the ABLE account. And I did find a lot of information. So if you go to the internet, I'm quite sure you'll be able to I can't find it right now. We're going to move on to, but it's actually interesting. It tells you where that name Pool Trust comes from. And that's actually an interesting backstory. But I want to get to so much more stuff for you guys. So we will go on to the ABLE accounts. This is the official site for New York State ABLE accounts. And I want to start with this. You can see this, right? Okay. I'm going to start with this about the ABLE accounts. Okay. A New York ABLE program designed specifically for New York residents. New York ABLE accounts give earnings the ability to grow tax deferred and allow savings to be withdrawn tax-free for qualified expenses. They have a drop-down menu here for the qualified expenses, but the main thing I wanted you to know was that it grows tax deferred and it can be withdrawn tax deferred. This is an excellent source. This, as I said, is the official website for New York ABLE. It's an excellent website to go over. I wanted to throw this in as well. Like many Americans, you may have received a stimulus check from the federal government. If you contribute your check to your New York ABLE account, it will not count as an asset for federal needs tested benefits program. Please review the information on this page to learn more. And as always, should you have any questions, you can call a representative from 8 to 8 Eastern Time at this phone number. If you're already receiving monthly Social Security benefits, you will get the stimulus check the same way. In order for the stimulus check not to count as an asset, you must use the money within 12 months. That's very important. Can you contribute the stimulus payment to your ABLE account? Yes, you can contribute all or part of your stimulus to your New York ABLE account. This means it won't count towards your $2,000 asset limit, even after the 12-month period is discussed, 12-month period discussed above is over. But you want to read everything. I'm just skipping around so that you can get a general idea, but you really want to read everything to make sure if you're about to do this, that this is what you want to do. Why should I consider putting some or all of this payment into ABLE? An ABLE account can help you save for things that are not covered by your federal and state benefits. If you don't need to use the stimulus payment for things right now, you could start saving it. You can save for disability-related expense. This includes adaptive equipment, a vehicle, a home, assisted technology, personal support services, and many other expenses. You can also use an ABLE account to save for disability-related expenses. Do I have to use the stimulus payment the same way that I use my SSI money? No, the stimulus payment is not a payment from Social Security. You do not have to follow Social Security rules when you spend it. Your stimulus payment can be used any way you choose. You could use your payment now. You could spend it within the 12 months. You could contribute to your New York Able account to give yourself more time to spend it while preserving your benefits, keeping in mind that if you contribute your stimulus check to your New York Able account to avoid negative tax consequences, you must use those funds for disability-related expenses in the same manner as other assets in your New York Able account. They have other stuff here. Will the stimulus payment disqualify me from receiving SSI benefits? As long as you use the stimulus money within 12 months, the money will not count towards your $2,000 SSA asset limit. After a year, whatever is left over will count towards your 2000 SSI. So you want to, the theme for today is keep good records. You want to keep really good records. And that's the theme I want you to take away today. Whether you are putting stuff on your Schedule A, which is on your tax return, you need to have receipts for that. If you're going to put your stimulus check in your New York Able account, you need to keep track. You need to keep very good records so you don't go over the 12 months with the $1,400 that we're about to get. This is definitely an alternative to keeping the money in your pillowcase. Yes.
No, just when you get a minute, we're gonna go through some questions. We actually have a few of them.
You got a couple of questions? Okay. This one more thing I want to say, and then we'll see if we can take a couple of questions. You can always get more information right here at the IRS Economic Impact Payments, and you can press on this link and it will take you right to the CARES Act provides assistance to workers and their family. So let's stop here for a question or two, and then I have some other juicy tidbits to share with you.
Really quickly, Mary, I don't know if it's hard for everybody to see, but your name is actually covering your hands a little bit. So I don't know if that's affecting anybody, but yes, sorry, I got distracted.
This is okay.
So I'm gonna go with the shorter questions first. So, are pooled trusts tax deductible?
They are not. They are taxed. Pooled trusts are taxed. The able trusts are not.
Okay. The other one is pet care for emotional/service needs, medical deductions.
That may be, as long as your doctor is willing to give you a prescription for the medical animal.
Mm-hmm.
Like eye dogs, support animals. It has to be ordered by a physician.
Okay. If you are receiving more than $25,000 in SSI benefits, they tax you for half of any amount over. Can you explain this?
It's just Social Security benefits, not SSI.
Oh, I'm sorry, SSI.
Yeah.
I mean, I keep saying.
Yeah, because disability is not taxable. Regular Social Security, yes. You have to add that there's actually a formula. That it's a chart in you'll find that in the Pub 17, publication 17, as well as the instructions on the 1040. You will find the chart. And if your Social Security and your income is more than 25,000, yes, some of it will be taxable. Yes, even though it's Social Security, some of it will be taxable.
Okay, STAR, DHE, SCHE? Can you, wow, I feel all sideways. Can you have a decimal in one state and still be a statutory resident of another state?
Can you say that again? Can you?
Can you have a
Can you have
domicile
oh,
in
thank
one
you.
state and be a statutory resident of another state? So if you have a residence in a different state, can you be a resident of another?
Okay. You can live, you can have a house, you can have an abode in more than one state. You can have a house in New York and you can have a house in Florida. And during the winter, you go to Florida because you don't like the cold weather in New York. You can have as many homes as you want, but you're only going to have one place that you actually call your main home. The state that your main home is in, you will do a resident tax, a state resident tax for that state. The state that your other house is in, you may have to do a non-resident. And I'll give you a quick example of that. There's a lot of people who live in New Jersey and work in New York. So they would do a New Jersey resident, but because they had earned income in New York, they would also do a New York non-resident. So you can live in more than one state, but depending on what happens in that state, you may have to pay taxes. You may own a house in New York and live in New Jersey, which means you have rental income in New York. You would have to do a non-resident to pay tax on the money that you earned in New York. And you would have to do a New Jersey resident because you live in New Jersey. But that's on the state side. On the federal side, all of your income goes together. They don't care what state it comes from. It can also be foreign income. You can have outside of the United States income. You also have to put that on your federal tax return as well.
So the next question is an interesting one. He says, I have past due taxes which have accumulated after my disability arose. I always filed on time and most go back 10 years. I'm currently on uncollectible and was wondering, can bankruptcy wipe out the federal portion, 10 years statute of limitation? And how about New York State, more stringent, 25 years? IOC are important and have had multiple tax experts say it's a waste of time.
Okay, the first thing I'm going to say is that person needs to speak to a lawyer. There's different types of they have what is it? They have number 7 and they have different types of ways that you could write that off if you're going to claim bankruptcy, but you have to have the right bankruptcy. So you have to speak to a lawyer about that because you have to have the correct bankruptcy number. It may not be 7, it may be something else. So I don't know that much about bankruptcy because I'm not a lawyer. So you would have to speak to a lawyer about that. But I have seen taxes written off on a bankruptcy. You just have to make sure that you do it correctly. And the other thing is you would have to actually do the return to see if you owed something and have the penalty and interest added on in order to wipe it out. You can't wipe it out if you didn't do it yet.
All right. The next one is medical expenses, which is interesting. If you get a larger unit to accommodate your disability equipment and live in home care, are you able to continually deduct the difference of rent? Example, let's say you rent a 1-bedroom apartment but need a larger unit to accommodate your equipment and your home care. Can you deduct the uh, additional portion of the rent from as medical expenses.
Rent is not, I don't believe, is deductible as medical expenses. But there may be, if you're disabled and you required that for your equipment, there may be a loophole in which you can take off some stuff. It may not be rent. But that, again, is something that you would have to go into. Again, I am at BCID currently, even though we're working from home. So we could do phone or we can do Zoom. If you have questions that I haven't gotten to here, you can always call BCID 718-998-3000. Make an appointment with Kim for the financial coach, which is me, Debra Brown, and we can go through some of these things on an individual basis. We could dig a little deeper, but I really just wanted to go through just a general overview to get your juices flowing, to get you thinking about different things. And we have about 10 minutes left. So I want to, there's one more thing that I want to do really quick. You can still keep your questions coming in. I will get the questions and I will get the answers back to you. The last thing I wanted to talk to you about is actually, and I was surprised to find it on this page, this was actually what my webinar was going to be about today. Where can I find more information about supporting financial decisions that you may have to make? There's a great agency called Consumer Financial Protection Bureau, and they have this wonderful book called Your Money, Your Goals, Focus on People with Disabilities. And this book, I hope this works. Tell me if you can't see it. Can you see it?
All good.
Okay. This is a wonderful book. You can go straight through the company. You can go straight through consumer finance, or you can go to ABLE and come down to the bottom and go through this. This has a number of different categories that helps people with disabilities to make some choices that they may need in setting goals, saving money, tracking income and benefits, paying bills, getting through the month, dealing with debt, understanding credit reports and scores, choosing financial products and services, and protecting your money, which is about theft, identity theft. Community Service Society, the company that I work for, we do a lot of credit reports and scores. We show you how to pull your credit report. I show you how to read the credit report. We also have some form letters to help you if you have disputes on your credit report. So again, you can make that appointment. We can go in depth with what your concerns are, but this is an excellent way to start off. They have different forms here to help you if you have goals, if you have reliable transportation, if you have a reliable source of income, to help you write stuff down so that it fits a little better in your plan and in your mind as to what you want to do, how you want to do that. They also have here, if you answered yes or I don't know to the different questions, they have different resources, reference resources that you may be able to use in your quest to get to your end goal. They tell you how to pull your credit report, annualcreditreport.com, which is the same site that I use with my financial coaching and CSS. You do not ever have to feel like you are alone in this journey. I am always here to listen to you, to commiserate with you, to help you get to your end goal, help you setting your goals, help you, and there's no right or wrong way to do anything. Everybody has a different way that works for them. That doesn't mean it's right. That doesn't mean it's wrong. Okay? It just means that that's the way that works best for you. There's always ways that you can save. If you can't open a bank account, there is a website with credit unions on it that you can go through, that I can give you, that you can find a credit union. You don't have to always cash your check at the local check casher that's going to take 4% of your money. All of these things is what we talk about with saving money. How to make meal plans so that you don't have to cook every night or buy something every night. I also have a webinar that I do on life insurance, retirement, investing, and savings. We do a little bit more, go a little more into savings, but I have to know that I have the audience that's interested in that. So if you're interested in any one of those things, I would suggest that you get in touch with Jay or Jessica and let them know that you would like to have that webinar. And again, an hour is not really enough time for us to get into the meat of the situations, but it is enough time for me to have you actually think about what it is that you want to do, maybe put it down on paper, and maybe start to make steps to strive to become more financially independent, to have some new avenues and some new places that you can consider, such stuff that you hadn't thought about yourself. And once again, I would love to thank you for joining me today. I hope I've answered some questions. I hope that you have learned something. I would like to thank Jay and Jessica for allowing me this hour with you. I want to thank you for coming in. I want to thank Mary, who I definitely could not do without. Thank you so much, Mary. And anytime you want to see me or have me back again, I'm only a phone call away.
And
thank you once again for your time.
We have people who asked if you could share the link to this website in the chat box.
The link to where this book here is?
Where you are on right now.
Okay.
I'm assuming that's it, right? Your money? Yep.
Just copy the link and put it into the chat.
Okay. Here is the link.
Right click.
Right click.
Right click on it.
Okay.
She did. Didn't she? Right?
No, it was outside.
Oh.
Right there, look, save link. Copy link address. Yeah.
Copy link address.
And then put it into the chat.
Into the chat, right?
Mm-hmm.
We're gonna figure this out. Okay.
Yep.
Where is the chat? Here it is. And there it is.
Oh, yep, there it goes.
I've done it for you.
And I'm gonna ask, I wanna ask one quick question.
Sure.
And it's a fairly simple one. Someone asked, someone receiving SSDI or SSI and unemployed, should they file for yearly taxes?
They should get the credits that they're entitled to. And I'm glad you brought that up, because one thing I neglected to say is that you are entitled to this credit for 3 years. So in addition to getting the $63 school tax credit for this year, 2020, You can go back as far as 2017. If you have not gotten these credits, you can go back to 2017. You can get 2017, 2018, 2019, and 2020 this year if you have not gotten those credits. So even if you do not file a tax return, if you are living in one of the 5 boroughs, you are entitled to that school tax credit.
All
And
right.
don't let the government keep your money. Thank you so much. You've been a wonderful audience once again, and I look forward to talking to you again.
Thank you, Deborah. Thank you, Mary.
Thank you. Thank you.
I just want to say that I did copy everyone's questions that we didn't get to, and we will follow up if we can. All right.
Yes, we will definitely follow up and get back to you with your answer. An hour is just not long enough to spend with great people like you.
All right. Thank you. Thank you. Have a good day.
You too. Bye-bye.
Bye.